There has been a lot of concern in markets over the last few months, from the war in Iran sending oil prices soaring to concerns about whether or not this big AI data build out from all of the biggest tech companies will see a return. Consumers aren't feeling great, business owners aren't feeling great, inflation has been sticky, the list goes on and on. However, the S&P 500 year to date is not only positive, it's almost double-digit percentage higher. And there's one big reason for that, and that is earnings. So earnings have just crossed a threshold we typically have not seen that often in the last 35 or so years. In fact, it's only the sixth time in that period where earnings growth in the S&P 500 has broken 20%. So that is what is really driving the markets here, despite all of this uncertainty. And so in this video, we're going to show you how to forecast earnings using the business cycle. So as I mentioned, we're going to look here at deconstructing the return of the S&P 500 year to date thus far. And this chart here is staggering. So dividends contributing a little bit, multiples, if we skip to that third section, taking away a lot from the return. So multiples have actually contracted. But look at that earnings bar. This market has been almost entirely, basically has been entirely driven by earnings growth in the S&P 500. That is despite a double-digit percent contraction in multiples. And that's how we get to the almost 10% year-to-date return in the S&P 500 at the time that I am recording this video. Obviously, things could change. So when we talk about earnings, what's nice is a lot of people focus at the company level. But when we're talking about for the S&P 500 as a whole, you can actually zoom out and look at the business cycle. So what you see here is we use the ISM New Orders Index, which is a leading indicator of the economy. And you can see that it has about a 9-month lead on reported earnings. So the earnings that companies actually release. If you're following leading indicators like the ISM, you can have a general sense of where earnings are going to be headed. And so if you look at this, you can see that since about December 2023, now obviously the ISM New Orders Index is advanced, so that would be talking about in 2022, early 2022. But in this chart, December 2023, you can see the ISM New Orders Index starts to trend higher. And that is about when earnings for the S&P 500 bottomed. And so what we've seen since is earnings trend higher. So again, if you were tracking leading indicators against earnings, you potentially could have seen this rise coming. And it's not just reported earnings. The business cycle also leads forward EPS or earnings expectations by less time, but by about 3 months. So earnings expectations we actually consider to be a late leading indicator. So it itself is a leading indicator, but it tends to move later than some of the other ones. So here I actually took the Conference Board Leading Economic Index, so the whole thing, and plotted that against forward EPS for the S&P 500 and advanced the LEI by about 3 months. So the lead time is shorter, but there is still a lead time here. Now, one thing to mention, if you look at the big chart on the left, it looks like it's sort of the relationship is broken down a little bit. S&P 500 earnings have risen faster than the leading economic index would have anticipated, but that just has to do with different axes that I'm using, right? The chart on the left, it's a longer term chart, so I'm using the best axis for that. But if you zoom in on where it looks like the relationship broke down, adjust the axes, you can see it's still really trending hand in hand. Business cycle leads forward EPS by about 3 months. So we can actually deconstruct company earnings. Again, this is a very simple way to do it. Earnings expectations are a function of many different things, as I say here. But if we're going to look at the two most influential variables, that's going to be margins, or how efficient a company is, and sales. So what is their revenue or top line growth? And both of these happen to be heavily impacted by macro influences. So we'll start with revenues, and those are just largely a function of economic growth. Or another way to say, they ebb and flow with the business cycle. So if you look at the chart on the left, nominal GDP with S&P 500 sales, they are move sort of one in one with each other. When the US economy is growing nominally, S&P 500 sales tend to go higher and vice versa. Now, so if S&P 500 sales ebbs and flows with GDP, yes, you can use leading economic indicators like the ISM to forecast S&P 500 sales. In this case, it leads it by about 6 to 9 months, depending on the period. In this chart, I used 9 months. So again, revenues, so one part of the earnings story, is a function of economic growth. And then we get to the other side where you have profit margins. There's a few things I could have done here. I wanted to stick it more to the Fed. I could have used a different rate series that would have had a little bit of a better fit. Anytime you're charting the federal funds rate, just sort of how jagged it moves, how stepwise it moves, the charts can get a little funky. But if you zoom in on the big periods of change in the Fed funds rate on this chart, you can see that profit margins are strongly influenced by monetary policy. And obviously, the relationship here is interest rates. So, Fed policy influences margins. When rates move higher, profit margins tend to move lower, and vice versa. So, there's an inverse relationship between these two series. And then finally, this is a very interesting chart to me, and it honestly leads to more questions than it does answers. So, gross margins have been historically a function of input costs. So, historically, input costs have been hugely influential for gross margins. You can see I did this to the mid 90s, all the way through about 2017, it appears. There was an inverse relationship between these two series. And that makes sense intuitively, right? So if input costs are rising, you would expect margins to contract and vice versa. If input costs are falling, you would expect margins to rise. That makes sense. And that was the relationship for quite some time. However, something changed in around 2017, 2018, where this relationship completely flipped. Now, again, I said I have more questions than answers. Here are the questions I have, or some of the potential reasons for this. So number one, the index composition of the S&P 500 has drastically changed over the last decade. Technology companies, which are asset light and less impacted by the ebb and flow of input prices, now make up a huge portion of the S&P 500 and just much larger percentage than it did in the mid 2010s and obviously before. The second reason, obviously, we had tariffs. So tariffs just sort of shifted the entire supply chain ecosystem. On top of that, the COVID-19 pandemic led to inflation, led to further shifts in supply chain. Now, those two reasons, to me, would better explain if this relationship just broke down, right? So now that companies are more dynamic with their supply chains and they've adjusted things, maybe there's less of a relationship between input prices and margins. For the asset light tech companies, right, they are less impacted by changes in input prices. So maybe the relationship would break down. I am struggling to get to the point where I would understand why those two things would cause the relationship to completely flip. So if you look at the small clip chart here on the right, you can see that import prices are no longer inverted. So what that tells you is when input prices rise, about 12 months later, margins also tended to rise. And that brings me to my third point. I wonder if US consumers were so conditioned to expect price increases over the last decade or so, as inflation started to rise due to a variety of reasons, and it has remained relatively sticky, that companies were then able to directly not only pass through, but also eke out extra margins due to the fact that input prices were rising, and that is the reason that they gave. So they used input prices rising in order to expand margins. Now, again, unclear. That is what politically the conversation obviously comes to greedflation. That is not what I'm saying. It is just one of the potential reasons that could explain how this relationship has flipped. I'm very curious to hear if other people have thoughts on this relationship, but that's what I'm going to leave this video with today. Again, markets are really being driven by earnings right now, so it's important that you know how to use the business cycle to forecast earnings, and that is what we teach in the Macro Specialist Designation Program. So if you're interested, you can find a link to our program in the description of this video. I hope you're having a great Monday morning. I hope you have a great week, and I will see you next week for another Macro Monday video.